Welcome to Indianomics. My guest is the most watched governor after the most watched monetary policy, Governor-Raghuram Rajan. Thank you very much, Dr. Rajan, for joining us.
Thanks for having me.
Well, in the post-policy teleconference, you all gave us a new number for the inflation estimate for March 2017. 5.4% was what Michael Patra said, March 2017. Now that's...
no, I don't think he said that.
He said that because there are several analysts who messaged me back.
Yeah.
It was 4.8% in September when you gave us a forecast for Jan 2017.
Yeah.
And now Michael said 5.4. I mean, what is your estimate of March, Jan-March 2017?
No, look, from when we made the estimates in September to now, what has generally happened is the information that's come in has caused us to reduce our expectations of inflation, the information that has come in. Then there are risks going forward which tend to elevate our estimates, risks such as the pay commission, for example, and the evolution of food prices post two tough monsoons. So in general, I would say that if you look at our curve, it's broadly in the same place it was as in September, with a slight bias towards the downside. That's what's in the policy statement.
The incremental information gives you a sense of lower inflation for what period? Along the curve or only for January 2016?
No, so certainly for the near term, it gives us a greater sense of where we will be. But what I'm also saying is that we had in mind some of these risks that we've highlighted here. To some extent, if you think that pulses have been more persistent over the last few months than one thought, that has been offset by the realization over the last couple of months of inflation slightly below where we expected it to be. So it's in that sense that some of the information has come in lower. Plus, if you look at oil prices going forward, that also gives a certain amount of comfort that it has stayed relatively low, because we have to see what OPEC does.
But if you take your comments on services inflation, non-food, non-fuel inflation, as well add to it, impulses from GST, 7th Pay Commission, would you be? I mean, are you still reiterating 4.8% in January of 2017?
Well, it's in the ballpark of that number. I'm not sure that I would say exactly 4.8%, but
not 5.4.
No. Otherwise, we'd be somewhat off where we intend to be. I think of the factors you mentioned, such as the pay commission, some of the factors are going to be balanced by government action. Of course, the additional outlay has to be balanced by an appropriate, finding space so that the fiscal sort of deficit targets aren't breached. So that will offset some of the inflationary impulses. Some we'll have to look through, as we've said, there's some mechanical calculations.
Yes.
We have to be careful we don't overlook what is necessary to look at.
Okay.
So that we'll have to work out as we go along.
But what is the requirement of the monetary policy agreement? You have to start, your clock starts ticking only in January 2018?
1st. No, January 1st, 2016. Clock starts ticking.
At 6%?
At 6%.
And the MPFA also says that January of 2017, 5%?
No.
It doesn't say that.
That's a self-imposed movement towards the midpoint of the range, which would give future monetary policy committees sufficient room to stay within without violating. That's where we would desire to be over the medium term.
So now the 6% looks achieved, so you don't write letters now. The next exam for you is January of 2018? 4%?
No. There is actually no exam past the 6%. If you look at the details of the monetary policy agreement, we have to stay between 2 and 6. That is all that the monetary policy agreement calls for.
Okay.
However, with abundant prudence and knowing that the whole sort of range was set, keeping in mind that it would be better to be around 4, we would like to migrate towards 4 over time. But what is in the agreement, where we start writing letters and doing penance, is if we exceed 6 on average for 3 quarters.
Or undershoot 2 on an average.
Undershoot 2, which I think is a little distant right now.
Okay. Well, probably even overshooting 6 for 3 quarters immediately doesn't look likely. But now let me come to the exact other side of the question, growth. Now, do you really believe the 7.4% number? Everybody will tell you, and I guess you feel yourself that it doesn't feel like 7.4%.
Well, I keep reiterating what Dr. Pranab Sen said about this, which is the new numbers can't be compared one-to-one with the old numbers. And his view was that there will be a difference, and therefore when you say it doesn't feel like, you're saying it doesn't feel like 7.4% according to the old numbers. And that was perhaps because that, put more weight on certain aspects of growth.
Nominal growth is 6% according to the GVA, the number. Look at the corporate profits of that same quarter. It was down by 3%. I can understand top line. But if you said margins should have improved, then at least bottom line should have been, it's down 3%.
Well, it depends on sector again. Some sectors are down partly because there's global deflation or overcapacity in those sectors. You would expect in those sectors both the top line and the bottom line to go down. But there are some sectors where input costs have come down substantially and output costs haven't gone down as much, so profitability has increased. So it varies. I don't think it's as uniform or as gloomy a picture as you suggest. Nevertheless, when you get into situations where your deflator is doing a lot of the walking for you, you have to be a little worried. And that's the sense in which I think you are, because we always tend to associate growth with nominal numbers. And it's hard for us to see low nominal growth but high real growth, because in fact we are in deflation. My point is the
real growth from, clean numbers like corporate is not even, reflective of the nominal number. Well, that was my point.
What I would agree with is that relying a lot on deflation for your growth is problematic. It's also, there is a real question of, are we deflating by the right numbers? And are we deflating something which should be deflated by CPI? By something like WPI. Those are questions that have always been asked. We continue asking, but they assume a lot of importance when the two diverge.
Okay. Well, I think this debate will not end. So let me get to another question on growth. Where do you see growth coming next year? I mean, it doesn't look like, CapEx is picking up at all. And if you insist on the fiscal deficit going down to 3.5% in spite of one rank, one pension and seventh pay commission, even the public investment impulse will not be there. So next year growth is going to be tougher.
Well, first, there is a lot of cleaning up which has been going on to remove some of the legacy issues, right? Some of it is happening, in areas like power. Some of it is happening on bank balance sheets, which we are very determined to see through. So that will unclog some sectors and allow for some growth there. Then there are massive investment projects which the government has been emphasizing over time. Some PPP, some government focused. Those will start coming on stream as we go on. Those will create demand for some of the goods that the private sector also provides. Now, we've always said, capacity utilization is low, but it's about 70%. Now, the norm is not 100%, it's 75%. So we need to get up some way before the private sector starts kicking in and investing. The other thing people often forget is, you can have a few years of low investment, but eventually the capital goods depreciate. And so you've got to put in new investment just to keep up or replace the old stuff. So after a few years, we've had a few years already of low investment, you would expect the investment cycle to start picking up itself. Okay. So all these would be positives. Now, of course, the virtuous cycle is then when that creates more jobs, people feel more confident, they go out and buy. Now, last is one of hope rather than knowledge. We've had 2 bad monsoons in a row. Historically, we've not had a third. Of course, in a time of climate change, one could argue anything is possible. But I would say the odds of a third bad monsoon are probably relatively small. I know, we need to think about the structural forces rather than just play the odds. But it's improbable.
You're still betting on a better growth next year.
Well, I'm hopeful. I mean, I don't lay bets on growth.
All right, no, I won't come to estimates simply because it's way far out. Let me come to the other number in the GDP.
Let me also emphasize one thing which we should stop fixating on these precise numbers, partly because, as you know, numbers get revised. We saw in 2010-11 the huge revisions. For example, one of the things we see in our data is when you look at the subsidiaries of foreign corporations, which typically don't tend to get picked up in the first of growth. Growth there, sales growth, is significantly higher than comparable firms in Indian firms. And these things are not small. They're about half in terms of sales, or I would say between 1/3 and a half in terms of sales as Indian corporation. The point I'm trying to make, for a long time we didn't look at small firms. We got them late again from the annual survey of industry. And again, they tended to boost growth. So let's not fixate on the precise first estimate of growth and what. Let's instead ask, do we have the underlying forces for strong and sustainable growth? And I think we are trying to put those building blocks in place. Okay.
Well, let me fixate on another number which came in the GDP data. Exports, minus 4.7%. Not that we needed it. For 11 months it's been contracting. Aren't you guilty of keeping the rupee overvalued? 13% overvalued, even if you argue against the RER being a bad measure. It's still seriously overvalued, isn't it?
No, so if you say it's overvalued, right, our exports should be doing terribly compared to our, our Asian this thing. No, we're not. So it's certainly not. A lot of countries have lower
down
exports.
Down 20%, 19%.
Oh, no, but there you're not taking into account the price effects.
But that is affecting even Chinese exports. Everybody is affected by lower prices. Chinese exports sell 6%, ours sell 19%. And what is our base?
No, but see, don't take China as your only comparison. Look at East Asia in general. Across the board, you will see exports are suffering. I'm not saying exports are in a good place, but
are you not admitting that there is an overvaluation of the rupee? Serious overvaluation.
No, but you tell me, what are the forces keeping it overvalued? Have we had huge capital inflows over the last few months?
Reasonable FDI flows. Debt flows up until 3-4 weeks ago were positive.
10 billion. 10 billion is our net accretion to the capital account. It's not anything to knock the exchange rate off tremendously. If you look at real effective exchange rate over the year, you look at nominal effective, it's been about flat. Okay. Now you're making the opposite point to what your newspapers make. Our newspapers make every day.
That's how you escape, because the newspapers say rupee falling.
Yes. No. So the bottom line here is are we in a position of serious overvaluation? How do we measure that? If in some of the more competitive industries, we're still finding fairly strong growth. Take autos, one of the most competitive industries. Auto exports are still quite strong. Ancillary exports are strong. If you look at something like apparel exports, that's perhaps the most competitive industry in the world. So it's not as if we're suddenly getting outcompeted in areas that are fairly competitive. Where are the biggest problems? Steel. Where we have global overcapacity, right? And in fact,
they're getting killed because of the overvaluation is an additional problem for them.
No, so what I'm saying is, no, this is not the fact that our exports have fallen is not a good thing. But is it vastly different from the rest of the world, where exports in general across the world, certainly across the emerging world, have fallen tremendously over the last year?
Governor, you mentioned imports. I think that is the bigger problem. I think exports is not such a big contributor. But imports are, cheaper imports are killing tires. You can speak to MRF, the most competing competitive.
No, you're absolutely. But is the question the exchange rate or global overcapacity which is killing prices? I mean, it's not across the board. It's not as if suddenly we're importing a huge amount of cars.
You could make it a little better if you allowed the rupee, or you ensured a rupee depreciation. Everyone's doing that to their currency, and that's always your grouse against everyone.
What you're assuming is we have this magic button that we can press, and suddenly the rupee goes to value X, and then we press something else and it goes to value Y. I mean, what we have always done is ensure that there's limited volatility in the rupee.
Yes.
And that's been our focus. It's very hard in this day and age to say, I want to be thus and such place. Furthermore, I think if you look at some of our emerging market sort of colleagues, if you will, the ones that have had serious depreciation, large depreciation, haven't gained significant competitiveness because what's happened is inflation has taken off. And so what they've got from the depreciation, they've given back from inflation. So unless you have significant credibility on monetary policy, which, you know, for a variety of reasons industrial countries seem to have, they seem to be able to engineer a depreciation and get some export competitiveness. However, emerging markets find it much harder.
No, I take your point, actually, but I have to take a break. I've not finished the argument on global currencies. There is a lot, I guess, to worry about. We'll come back with questions on the inclusion of the yuan in the SDR calculation, as well as the impending Fed action. All that with the Governor in a minute.